Let's also bring on board Robert Parker, Senior Advisor at Credit Suisse. He joins us on the show from London. Robert, hi, morning. Good to have you on the show as always. What's your 2014 outlook for emerging equities? Your peers seem to think that emerging markets will be a laggard this year.
Quite right to say that many people in the investment industry are forecasting an underperformance of emerging markets relative to developed markets. Having said that, if one looks back over the last 12 months to 18 months, one feature of global markets has been the underperformance of emerging markets. And, the right place to invest in 2013 was in developed markets, most notably the United States and Japan. We are now in a situation where most investors are heavily underinvested in emerging markets, and the valuations of emerging markets relative to developed markets are as cheap as they were at the bottom of emerging markets in 2008. So on valuation grounds, there is a case for saying that the downside risk in emerging markets will be very limited. In addition, if you look at investor positions, they are all long developed markets, they are all underweight or short emerging markets. And yes, there are a lot of negative factors at the moment, most notably, weaker growth numbers in emerging markets, but I do think the downside risk is low. I do think that as we probably go into the second quarter of 2014, you will start to see undervalued emerging markets start to attract renewed investor flows as investors increasingly take profits out of more expensive developed markets.
Morning, Robert. Nikunj Dalmi also joining in. So how are you looking at the post-tapering environment for developed market versus emerging markets? Do you see any danger of fund flows drying up for emerging markets?
Well, I think the first point to make is that the only people who are tapering at the moment are the Federal Reserve, and they're doing it very slowly indeed. And yes, I do think that quantitative easing will probably end at the end of 2014, but the process is going to be, as I say, a very slow process. Easy monetary policy remains very much intact in Europe and in Japan, and I think the only other central bank which is going to reduce quantitative easing through 2014 is the Bank of England, given the strength of the UK economy. So I think point number one is that the process of tapering is going to, I think, be done in such a way that it won't damage markets. I think the second point is that whereas markets, and particularly emerging markets, 6 months ago were very sensitive to expectations of Federal Reserve tapering, and we saw, particularly in the late second quarter of 2013, a capital outflow from emerging markets. As I mentioned earlier on, investors are now very underweight emerging markets, so consequently I think actually emerging markets' vulnerability to tapering is now minimal.
Robert, some experts believe that US recovery is more or less discounted by markets and Europe might do better in 2014. Would you agree with that view?
Yes, I do. I think, just to quantify the growth outlook, it's highly likely that as we get into the second half of 2014, US annualized real GDP growth will be close to 3%, or possibly even somewhat higher. And increasingly the markets are discounting that. Having said that, I do think there will be some further modest upside in the S&P in 2014, but of course that will be constrained by the stronger economic growth numbers leading to higher bond yields. So, it's difficult to see the sort of performance in 2014 of the S&P than we had in 2013, particularly in an environment where 10-year US Treasury yields will probably progressively move up to 3.25, possibly even higher. In terms of Europe, I think the positives are that the Eurozone crisis is now largely behind us. I think the banking crisis is behind us, and the Eurozone is out of recession. And I think what's particularly promising is not just the good data that's coming out of Germany, but also the significant improvement in data coming out of stressed countries like Spain. I think also one should mention that the bailouts in Portugal and Ireland are now sort of largely successful. So all of that suggests that European equities will perform and will outperform US equities in 2014. And I think a structural long position in Europe versus the States makes sense.
You've outlined the global picture for us. Let's talk about India. What about Indian equities? Your Asian strategist feels that India is at an inflection point. Do you share the same view? And do you think that after 5 years of a range-bound market, 2014 could be the big differentiator?
Well, I think, there are a number of critical issues for India. Obviously, the first one is political, and I don't claim any particular expertise on Indian politics, but it does look likely that there is going to be a shift in government at the general election. I think the creation and development of this new party, the AAP, is a fascinating development. And if you had a coalition between the BJP and the AAP, I think that actually could lead to interesting and very positive reforms economically. In terms of the growth outlook, I think we're probably past the worst. What would be very positive for India, apart from domestic structural reform, would be a fall in the oil price. And I think the balance of probabilities is that we will see weaker trend oil prices in 2014. That will be positive for the Indian current account and for growth generally for the economy. Clearly, we had a very good rally in the latter part of 2013, and having said that, and although the market looks somewhat expensive relative to markets like China and Brazil and Russia, I do think capital flows will continue into India, and also I think interestingly that domestic capital flows will probably move increasingly into the equity market. So I think the trend outlook for the equity market, although there are a number of risks, such as the election, in addition, one shouldn't forget that budget deficit needs to be dealt with, but I do think that the balance of risks is positive.
Robert, do you think growth can pick up for India in the second half?
I think growth will pick up. Growth needs to pick up. But after sub 5% growth, my forecast is that growth will, approach 5.25%, 5.5% in the second half of the year. Obviously, one would hope and prefer growth to be back, north of 6%. However, I think it's way too early to make that forecast.
So what themes do you think will play out for India for this calendar year 2014?
Well, I think a number of themes. Theme one is obviously that, while the currency has stabilized sort of between 62 and 63 against the US dollar, one feature of last year was obviously the weakness of the Indian rupee. I would argue that the Indian rupee is now undervalued and cheap. It's particularly cheap relative to the strong Chinese renminbi. So I think point number one is that India now has an export advantage from the currency. So the export sectors, I think, and I would include in that the IT sector, I think are interesting. I think the other sector to highlight is the focus on domestic consumption, and if domestic consumption, particularly sort of more middle income or lower income domestic consumption improves, I think the retail sector could be interesting as well. But it would be basic consumer sectors or household sector, household goods, rather than the more luxury end or the upper end of the consumer sector. So more consumer staples rather than consumer discretionary.
So what is it that you're expecting from the upcoming earnings season?
Well, I think the trend in 2014 in India, like a lot of markets, is going to be a progressive improvement in corporate earnings growth. And if one forecasts, this year, inflation at around 9%. One forecasts growth, let's say, at around 5%. Therefore, with a nominal GDP at around 14%, with that undervalued currency, I think it's fair to say that corporate earnings growth on trend will be north of 10%, and that the trend will be one of steady improvement as the year progresses.
In India, the Reserve Bank of India kept rates on the hold to assess the macro situation on inflation. How do you view this move? RBI governor believes that he should not err by over-tightening the economy. Do you concur with his view?
Well, I think the key point is that the RBI has a very difficult challenge with an elevated level of inflation, which we would all agree is unacceptably high, but conversely, the need to move growth back to above 5%. In a situation where you've got high inflation, a budget deficit, a current account deficit, and weak growth is obviously a very difficult environment for a central bank to operate in. I think, therefore, it was probably right for the RBI to stay on hold. If economic data starts to get better with growth moving back above 5%, I think some easing in inflation pressures as commodity prices start to come off. I think at least for the next 3 months the RBI probably stays on hold. And whereas previously I thought they might actually tighten further, I think they now have more of a growth bias towards trying to get the economy back on a growth path north of 5%.
Robert, really good chatting with you. Appreciate you taking the time out and speaking with us today.